Good morning, everyone. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Mark Kimbrough.
Hey.
It's shortly after 10 a.m. Pacific on Friday, August 15th, middle of August. Hope all of your summer is going well. We're sitting here, President Trump and the President of the Russian Federation, Vladimir Putin, are set to meet in Alaska outside of Anchorage. That's supposed to happen at noon Pacific, 3 p.m. Eastern. So that's definitely something interesting occurring today. With that, we'll just jump into the bloodless verdict of the market for the week. And the S&P 500 up again, plugging new highs earlier this week. There was a bit of a sell-off, but this week the S&P's up 1%. And interestingly, the technology sector is actually down on the week, one of the weakest sectors, only down 10 basis points, mind you. It was rounded out with another two losers being consumer staples down 0.5% and utilities down 0.5%, but every other sector was in the green. The big winner was communication services up over 4% and consumer discretionary up over 2%. Healthcare, interestingly, was the best performing sector this week, outside of that kind of, communication services, AI space. We saw that up 4.6% on the week. So pretty positive stuff in stocks, but there's been some dispersion, which is interesting, with technology being kind of a laggard and healthcare rallying. We've been having pretty positive earnings, so I think that's been driving some of that performance differential you've seen. And interestingly, the Russell 1000 value up 1.6%, while the Russell 1000 growth up about 75 basis points, 0.75%. One last thing of intrigue is the S&P equal weight index. So it's the S&P 500, but equal weighting all of the names in there, up 1.7%, outperforming the broad S&P. So, I don't know if this is that kind of rotation of capital towards, the less high-flying names, but at least for 1 week, we've seen that kind of trend, which is interesting.
On that note, I want to jump in with one, just the Russell 2000, our little small cap friend. It's up 350 bips on the year, but almost all of that came just this week. We had a little bit of that rotation of the small caps showing up as a bit of success here.
That is a good point, Mr. Kimbrough. I think that the fact that small caps are getting a little love is something to note. That said, as you mentioned, all of their performance for the year has come in 1 week. So, yeah, we'll definitely have to watch and see if that trend continues, but it is interesting. Moving on to the fixed income market. Fixed income market is broadly flat, looking at the U.S. aggregate, down about 5 basis points on the week, but there's been some vol there as, earlier in the week, rates had been holding steady, but they sold off, on the backs of the PPI report that came out on Thursday, which we'll dive into the details of, and definitely selling off again today a bit. Kind of looking at the rate market, the 30-year U.S. Treasury is out 8 basis points on the week. The 10-year U.S. Treasury is out 4 basis points on the week, and the front end of the curve, the 2-year Treasury is actually come down in yield by 1 basis point. So you got your steep interaction going on there. Kind of looking at that, the 2s 10s has steepened by 5, and the 3-month 10-year is steepened by 7. So that's definitely coming into play. Looking at the sectors of the fixed income market, the best performer is emerging markets. Emerging market fixed income up about 0.5%, followed by below investment grade corporate bonds up about 30 basis points. The weakest performer naturally is the government sector, down about 16 basis points. Mortgage-backed securities are roughly flat, down about 2 bips on this indicator we're looking at. Moving over to commodity land, it was actually a relatively flat week in commodity space. The BCOM, the broad index of commodities we're referencing here, was down 22 basis points. And kind of digging into it, interestingly, gold down 3% on the week. currently trading about $3,330. A little higher, a little lower, moving around. The precious metal sector was down 2.65%. The energy sector was down 1.5%. And if you look at crude oil, WTI crude oil is at about $63 a barrel, and it was down 1% on the week. And I think some of that is the action that's going on. If there's a peace that occurs, in the Ukraine war, or if there's some sort of shadow of a detente. I mean, there's clearly some sort of dialogue occurring. President of the United States and the President of the Russian Federation are having a bilateral meeting, which the speculation is maybe there'll be a trilateral meeting including Ukraine if this meeting bears fruit. We'll have to wait and see, clearly, but it's been weighing a bit on the oil market because the market is definitely well supplied, and if sanctions were to decrease on crude oil coming out of Russia, that could be a new source of supply to potentially drive prices a little lower. We'll have to wait and see. And we'll round it off with the currency space. The dollar index was down about 1/3%. There was some movement this week where the dollar kind of sold off and rallied, but the net of it is down about 1/3%. So not too much of a move there. And Bitcoin, everybody's favorite crypto, is trading at about $117,000 per Bitcoin. So that's definitely out of its highs that it was hitting, but definitely not a catastrophe in terms of a market sell-off. It's actually, as I said, up slightly on the week. So that kind of rounds out the markets for the week, unless you have anything to add, Mr. Kimbrough.
No, I think that covers it. It's markets that risk markets are sitting, near all-time highs. Spreads are tight, and these numbers seem to reflect that.
I tend to agree. People are grinding it out. Hopefully people are enjoying their summer. They're looking at their investment portfolios and they've been performing relatively well this year. So people are sanguine, but we'll just have to wait and see. Now, this was a big economics week, so we're going to have a lot to talk about. With Tuesday, we had the CPI. So why don't you just jump in?
Let's jump right in. As you said, this is inflation week. The first data point I have for the week is not inflation, but I'm going to cover it in about 30 seconds here. We got the NFIB Small Business Optimism Report for July. It was released on Tuesday, came in above expectations, came in at a 5-month high. And I'm just going to say in general, it's nice to see a little soft data that looks decent. I'll give you one quote and we'll move on. This is from the NFIB chief economist. Quote, optimism rose slightly in July, with owners reporting more positive expectations on business conditions and expansion opportunities. While uncertainty is still high, the next 6 months will hopefully offer business owners more clarity, especially as owners see the results of Congress making the 20% small business deduction permanent and the final shape of trade policy. Meanwhile, labor quality has become a top issue on Main Street again. End quote. So again, a little positivity there, but let's get to inflation week. We have Tuesday, we got CPI for the month of July. This printed the headline number at 0.2% month over month, right in line with estimates, slightly below the prior of 0.3. The core number came in right in line with estimates at 0.3%. It was a slight acceleration from prior of 0.2. That snapped a 5-month streak of core CPI coming in below estimates. So expectations have now converged with reality here. We've got CPI at the year-over-year level for the headline coming in at 2.7%, right in line with the prior, while the core number surprised the upside at printed 3.1%. That's 20 bips higher than the prior of 2.9. So cover a couple numbers here. We were just talking about the commodity sector. Energy prices have been falling this year. Energy was a nice contributor to the downside for headline, but trying to keep the focus here on core. We have core CPI month over month. A more precise figure, it was up 32 bips. It's the strongest print we've seen since January this year when it was at 45 bips. Within the core CPI, though, we split up between goods and services. Goods this month, actually kind of reasonable. This is going into this month, actually going to last month, there was talks of looking at core goods and looking for signs of tariff-induced inflation. There was a couple categories that were mentioned, and we're looking for a little follow-through this month, see how that developed. And we didn't get much, or at least didn't get an acceleration within the core goods sector. Within there, at the high level, every category of core goods decelerated from last month, with the exception of one, and it was entirely driven by used car prices. So I'm going to say that we got a little bit of a surprise to the downside, I'd say, relatively in core goods here. But core services came in at 36 bips month over month. That was versus a prior of 25 bips. This is primarily driven by two categories: medical care services and transportation services. But all in all, it seemed like going to this meeting, you would have expected core goods. That was a thing to keep a focus on, trying to look for tariff impacts. And you didn't see a lot of that show up, but you did get the surprise up in core services. So I'm kind of going to leave it there. And so it seemed like a decent CPI report, but kind of just a wait and see. Nothing, it's not an all clear for the Fed on their cuts, but it was not going to deter them either.
To jump in there on the CPI, I think that the CPI, I'm pretty aligned with you. I mean, the market reaction was relatively muted to that report, and I don't think that market participants really got too spooked by it. But that's and the feed through into the PCE wasn't super negative, but I do think it was on the hawkish side. There's definitely the inflation dragon hasn't been slain. That report didn't. That wasn't a report that I think the Jerome Powell's gonna look at and be like, "Oh, I love what I'm seeing."
I'll agree with you. I want to give one other detail to, kind of help support that there. The medical care services was one of the categories under the hood that, looked a little more alarming. It was up just about 80 bips on the month, highest September of 2022. And that is more than double the weight. We're looking at what Powell's looking at, core PCE. The weight of medical care services is 19% in core PCE versus only 8 in core CPI. So when you talk about that look through to PCE, that was not a helpful data point in this CPI report. Exactly as you were alluding to there. But look, we got a little more inflation data this week, so see if you can tamper that down a little. We have PPI for the month of July. This didn't tamper down at all. This was a quite heavy report. Surprise to the upside. We had the headline number come in at 0.9%. That was a firm 0.7 above estimates and 0.9 above the prior, which was flat. Same exact results for the ex-food and energy number, printing at 0.9%. This brought the year-over-year number for headline to 3.3%. That's a full 1% increase from the prior, while the ex-food and energy came in at 3.7%. That was a 1.1% increase from the prior. So not a good PPI report here, but I do think the results here are pretty interesting when you look under the hood. Looking at goods, look, not going to try and focus on things that have food and energy. We like to keep our focus more on the core side. The ex-food and energy makes up about 20% of the overall PPI basket. It was up 0.4% this month, 2.8% year over year. It actually was the strongest month-over-month print we've had since January of 2023. So something to keep an eye on there. That is a little upward pressure in the PPI reports. But more importantly, looking to services, that came up 1.1% this month. It's up 4% on the year. Makes up about 2/3 of the basket. But the most important category within there, in my opinion, would be at least this month, was the final demand trade services. This is the category that people started speaking to a few months ago. We're looking to margin pressures within the PPI report. This printed at 2% this month, positive. That's versus a prior of negative 0.3% and a 1.5% positive in May when this topic first started coming up. So this was the strongest print we've seen actually in this final demand trade services since March of 2022, and it made up about 40% of the headline number. So this would suggest that some margin pressures are expected to be felt. This report will reflect that. And, but maybe that could say that there's maybe a little less pass through to the consumer that we would see in CPI down the line. We will see as the results continue to come through, but, not the best PPI report, but it is interesting to see that the margin captured there.
Yeah. Market didn't like that report yesterday, in terms of the bond market. You definitely saw a sell-off in rates, and you saw the probability of an interest rate cut at the next FOMC meeting diminish slightly. Now, albeit, the market still fully expects a cut at the next meeting, but there's definitely that was a hawkish report. There's no ifs or buts about it. That was a hawkish report, and you can try and spin it if you want to, but if you're just trying to be objective, I don't think you can objectively say that that was a dovish report from an inflation standpoint.
I mean, a 1.1% increase in the year-over-year number is not what you want to see. That extrapolate that out, and you're not happy with that. So yeah, that's again, that was not did not really help offset anything in that CPI report. But we'll continue to move forward. We have also on Thursday, we got initial jobless claims for the week ending August 9th and continuing claims for the week ending August 2nd. Can say both these came in below estimates in the prior. Pretty tame reports. Both 4-week moving averages inched up by 1K, but I'm just going to summarize it there and just say 224K on initial claims and 1.953 million on continuing. So a little relief there. And that brings us to today's data. We got retail sales for the month of July. I think pretty decent report here. You need to factor in the revisions for the priors. The prior for both the headline and the ex auto and gas were revised up by 30 bips and 20 bips respectively. And we missed this month by 10 bips. So I'm going to say net, I'm going to call that a surprise to the upside. The control group, the one that hits CPI, that also was revised up by 30 bips and it exceeded expectations by 10 bips. So again, a pretty decent retail sales report here. Looking under the hood, there's three categories I'll mention. One is vehicles and parts, about a 20% weight in the basket. It was up strongly this month, 1.6% after a prior 4 months of declines. Actually, no, I'm thinking of a different report. This one was just, it was a strong contributor this month, but you get a little volatility sometimes in the vehicles and parts figures. We also got non-store retailers. That's online sales, 17% of the basket. It was up 0.8% month over month and 9.4% if you look at a 6-month annualized rate. So pretty strong spending there. But the detractor, the biggest detractor in this report, and it's our one look through into the services part of the spending economy, is eating and drinking in services category. Makes up about 14% of the basket, and that was down this month 40 bips. Reading this morning, saw a couple articles talking about this and trying to highlight, maybe some of this pullback in services spending and shift to arguably more, necessary goods, non-discretionary goods could signal a weakening in the consumer. I'm a little hesitant to try and extrapolate this one print. We've had 2 other prints this year where we had negative results for this eating and drinking category, and both times we bounced back much stronger the next month. So again, one data point not working in our direction, but overall, I would categorize this report as, decent, pretty decent. 0.5% is above the 20-year running average. I think is about 0.37%. So again, decent retail sales. Friday to get our last inflation data point of the week. We got, or at least last one I'll comment on today in detail. That is the import price index for the month of July. This surprised to the upside. It printed 0.4%. That is the largest print we've seen since April of last year. This resulted in the year-over-year number coming in still at a negative 0.2%. So still, strong print this month, but not a whole lot going on still on the import price side. Taking all three of the reports we got this week into account, now seeing estimates for core PCE ranging from, I saw 0.26% coming from Cleveland Fed this morning. I saw 0.28% on a couple spots on Bloomberg. This will result in core PCE inching up from 2.8 to 2.9%. We'll see that. I believe that comes in next week. And lastly, we have 2 more reports today. We got manufacturing data in the industrial production numbers. Nothing to see here. Flat numbers. It came out at negative 0.1%. The capacity utilization, I'm going to say it's been flat year over year. It's down 4 bips from last year. Not really any movement there. And then finally, we got University of Michigan sentiment data. This data kind of confused me today, so I'm going to report that it was reported on today, but I don't want to talk about the numbers, so I'm just going to leave it there and wrap up the week.
I think that was like you said, the most important information was the CPI on Tuesday, the PPI on Thursday, and then the import price data today on Friday. And I think the common thread, as you alluded to, was slightly hawkish and a slight increase in the expectations for PCE next week, which, or the week after, I believe. And that will naturally weigh on the minds of the committee members in the Federal Reserve, which will probably decrease the likelihood of a cut slightly. But, when we look at the interest rate probabilities right now, there's still 2 cuts priced in for the year. So, it's been a whole lot of talk and jibber and jabber, but we're still at 2 cuts priced in for the year, that Mr. Goodlock was predicting that back at the beginning of the year. And so, the market's moved around a bit and there's been a lot of talk, but realistically, we're just kind of where we were 8-9 months ago. So I think that's like really the takeaway from my point of view on the economic data for this week. But I think you did a good job kind of drilling into those details for our listeners. When you look at next week it's going to be a pretty light week. I mean, for you Fed watchers, you'll have the FOMC meeting minutes drop on Wednesday. You'll have the initial jobless claims and continuing claims naturally on Thursday. There's no prediction for a change. And then on Thursday, we get the S&P Global U.S. Manufacturing PMI and the U.S. Services PMI, which, definitely on a light data week, it's going to be something to kind of dissect a little bit.
Mhm.
And then last week, we get the leading index, the LEI, month over month. And, I like to call that the broken clock indicator because they're going to have to readjust their algorithm there and reset their parameters on their optimization because, that thing hasn't been very useful in the last 4 or 5 years, I would say.
It's
But
been rough. It's been rough.
yeah,
We'll see how that develops. It is what it is.
we'll see how it goes. But that kind of wraps it up for the week.
Ooh, actually, I got one more thing. Actually,
what do you
just
got?
remembered
What do you got?
from next week. I didn't talk about it this morning in our summary here, but Jackson Hole, I think, starts Thursday or Friday next week. We'll see if we get any sort of leaks of data coming from that. But that would be, hey, just a little queue up of potential fun next week.
Oh, that's definitely a good point. Jackson Hole is always interesting, and all eyes in a week like next week with very limited data, on Jerome Powell's speech. That'll definitely be a market mover, and it'll be probably watched a little too closely by market participants.
Looking for the tea leaves. Try to read the tea leaves.
Yeah, exactly. Reading those tea leaves, it'll definitely be one of those situations where every word is dissected and looked at through a microscope.
Yep.
So with that, we'll call it a week.
Yeah, thanks to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Thanks for tuning in, and I hope everyone has a great weekend.
Yeah, thanks all. Stay cool out there.